to Introduction to Finance Problem Solution videos. My name is Greg Pierce. I'm the finance coach, and we're going to go through in these videos instructions on how to complete some of the problems at the end of each chapter of Ross Westerfield and Jordan's 11th edition, Fundamentals of Corporate Finance. We'll do a limited number of problems per chapter. In the format we want to use on every problem is given, equation, solution. We find by using this method, this form, given equation, solution, or methodology, we find that we often get the problems correct, and it's easier to kind of solve the problems if we use that structure. So we're going to use that structure on every problem, given equation, solution, and we're going to attack these problems with that structure, and that will help us get these problems correct. After we're done doing them on the whiteboard here, we want you to be able to also type these numbers into your calculator and solve these problems using a financial calculator or a scientific calculator. You should be able to do this in both ways to check your answers, certainly. And then third of all, we'd like you to be able to type these numbers into Excel. Ultimately, when you go to work these days, it's expected you can build these models and change these numbers quickly, and you get different answers quickly. And that's very useful in the working world. So we want to approach these problems with that end, ultimately do them on the whiteboard first, on a piece of paper perhaps for you, or on your iPad or laptop or phablet. And second, we want to be able to type these into your calculators and solve these problems in similar fashion. And thirdly, we want to be able to type these structures into Excel and get the same answer. So that's our ultimate goal. Let's proceed with problem 2.1. We're given that KCCO has current assets of $5,300, net fixed assets of $24,900, current liabilities of $4,600, and long-term debt of $10,300. Our two equations we're going to use are assets equal liabilities plus owner's equity, the basic balance sheet equation. It's got to balance. And then secondly, net working capital. They want to know what is the net working capital for this company, KCCO, with those givens, current assets minus current liabilities. So first of all, for the solution, we create a vertical balance sheet. Current assets plus net fixed assets equal total assets. $5,300 of current assets, $24,900 in net fixed assets, give us total assets of $30,200. Based on the balance sheet equation, we know that we must have similarity here, so the same number, total assets must equal total liabilities. So I just bring over the 3,200 to the right side of the balance sheet. It's got to be, my accounting teacher used to say. And now we can solve for owner's equity, which is the question, what is the owner's equity in this case? So I'll simply take the 30,200 minus 4,600 of current liabilities from here, and minus 10,300 of long-term debt. So I enter those numbers, and by subtraction, I get a number, an answer of $15,300 is my answer to owner's equity. And then the final question in this problem, net working capital, what is it? Current assets minus current liabilities. So we take the 5,300 of current assets minus 4,600 of current liabilities, and we get an answer of $700. And there are your answers to problem 2.1. In problem 2.2, we have Billy's Exterminators with sales of $817,000, cost of $343,000, and depreciation expense of $51,000 with a tax rate of 35%. What is the net income is the question. How much is their net income? What does their P&L look like? P&L being profit and loss statement or income statement, as we've learned earlier. The equation we're going to use, those are our givens. The equation is sales minus cost equals net income. Sales minus all the cost will give us our net income, and that's what we're looking for in this problem. So we bring down our sales of $817,000, our cost of $343,000, and our depreciation expense of $51,000. Subtracting the cost and the depreciation expense, we get an EBIT of $423,000. I'm going to subtract the interest expense of $38,000. And that gives us a EBT or PBT, earnings before taxes or profit before taxes, of $385,000. Then I take the tax rate against that earnings before taxes or profit before taxes. 35% of $385,000 is $134,000. $750. And subtracting that from my EBT or PBT, I get a net income, or NPAT, net profit after tax, of $250,250. You can tell from these givens that we're building an income statement, right? Looking at those givens, it smells like an income statement, walks like an income statement, talks like an income statement. It's an income statement. P&L, as your boss might refer to it, and we're going to build it vertically with proper strike marks for subtotals, and then a double underline at the very bottom of the income statement. There are your answers to problem 2.2. In problem number 3, we're given that Billy's exterminators from problem 2 pay $95,000 in cash dividends. And we want to know what are the additions to retained earnings. What is ARE? So ARE is net income minus dividends. If we look at net income as a pie, we give away a portion and we keep a portion. The portion we keep called additions to retained earnings. So from problem number 2, I take my net income of $250,250. I subtract the cash dividends paid in problem 3 of $95,000, and I get a solution of $155,250. $155,250 is my answer to problem number 3. In problem 2.4, we're given that Billy's Exterminators has 90,000 shares outstanding, and that is given. We want to know what are the earnings per share and dividends per share, EPS and DPS. So very simply, earnings per share is net income over shares outstanding. Net income being the same thing as earnings. I prefer the word net income or NPAT rather than earnings, or perhaps net earnings would be better, but nevertheless you're going to get the word earnings tossed at you. You're supposed to know that earnings, same thing as net income. So NPAT, or earnings divided by shares outstanding, will give me my earnings per share. And then dividends per share will be the dividends paid from problem 3 divided by shares outstanding given in this problem. So earnings per share are $250. This was from problem 2. We all agree to that number earlier, divided by 90,000 shares that are given up above. And I get an answer of for earnings per share of $278.0556 per share, dollars per share. And again, I can squish that back to $2.78 a share. 2.780556 per share is the answer. Note, very important to include units. Earnings, or dollars per share. So at the end here, I'm going to put $2.78 per share is my answer. Dividends per share, simply 95,000 from problem 3, divided by 90,000 shares from this problem, and I get an answer of dividends per share of $1 and about 5 cents. $1.05556 per share. Again, I could scrunch that back to $1.06 per share. Again, units are important. Dollars per share for both earnings per share, dividends per share. There are your answers to problem 2.4. In problem 5, we see that Dry Deck Company had $267,000 in 2014 taxable income. What are their income taxes in 2014 using table 2.3, which is the corporate income tax table in the book. So what's our equation? We're going to step through the table and look at the tax bracket, all the tax brackets, till we've covered all of our $267,000 taxable income to calculate our taxes. So we just step through the table 2.3. So let's do that. So on the first 50,000 of your income, first 50 of the 267, we're going to tax at 15%, because that's what the table says. That gives us $7,500 in taxes on the first 50K. The next 25K is taxed at 25%. That gives us taxes of $6,250. On the next 25, we're going to get taxed at 34%. That gives us taxes of $8,500. And for the final 167,000, you can see these first 3 we've stepped through. We got 100,000 taxable income. We still have 167,000 left until we get to our total 267. So the next 167,000 is taxed at the 39% rate. That gives us taxes of $65,130. Add them all up, gives us our total tax bill of $87,380. So we've stepped through the tax brackets to calculate the tax on that $267,000 in taxable income in problem number 5. There's your answer to problem number 5. In problem 6, we're going to use problem number 5 again, where Dry Deck had $267,000 in 2014 taxable income. And in this problem, we're going to calculate the average tax rate and the marginal tax rate. So, equation. Average tax rate is total tax bill, defined in problem number 5, divided by taxable income of $267,000 that we saw in problem 5. And what is the marginal tax rate? That's the tax on the next dollar of income. If we made one more dollar, where would that fall into this table? So, we left the table from problem 5 up. We have our total tax bill of $87,380. So we're going to move that into the equation in this problem. Total tax bill is $87,380 divided by your $267,000 of taxable income that was given. I get a tax rate of 32.73% on average. Again, I'm dividing dollars by dollars, so that'll give us an answer in times or in percent, 32.73%. Now, the marginal tax rate is the tax on one more dollar. So if we made one more dollar, $267,001, that dollar would fall into this tax bracket, the 39% tax bracket. So again, our marginal tax rate is given then at 39%, because that one more dollar of taxable income would fall into this last slot, because we still have room available in that tax bracket. There are your answers to problem number 6. In problem 2.7, we're given that Ridiculousness Inc. has sales of $43,800, cost of $22,700, depreciation expense of $2,100, interest expense of $1,600, and a tax rate of 35%. Find the net income, find the OCF is what we're ultimately looking for here. So first, when you see the letters OCF, you know you need to build a vertical income statement. Equation being sales minus cost equals net income, and OCF equals earnings before interest and taxes plus depreciation minus tax. I add back depreciation because it's a non-cash expense. It's a non-cash item. So first of all, we take our sales of $43,800 given. We have our cost of $22,700 given. We plug them in, and our depreciation expense of $2,100, and we plug that in, and we get an EBIT, or earnings before interest and taxes, by subtraction of $19,000. From that, I'm going to subtract my interest expense, $1,600. So I get an earnings before taxes number of $17,400. I'm going to multiply that by 35% to get my tax expense, and that translates to $6,090. And by subtraction, I get my net income, or NPAT, of $11,310. So there you go. There is your income statement completed with NPAT, or net income, of $11,310. Now we need to tackle OCF. OCF is EBIT plus D minus T. So I simply take my EBIT from there in the income statement, $19,000. To that, I add back depreciation because it's a non-cash expense of $2,100. And then I'm going to subtract my taxes, which are also a cash item. I'm looking for operating cash flow, so my taxes are $6,090. Take those three numbers, 19,000 plus 2,100 minus 6,090, I get an OCF of $15,010. And there are your answers to problem number 7. In problem 2.8, we have Bowyer Driving School. Now, someone corrected me the other day, says, not Bowyer, silly, it's Boyer, Clint Boyer. Boyer Driving School has 2014 net fixed assets of $2.7 million and 2015 net fixed assets of $3.5 million. Their depreciation expense in 2015 is $328,000. What's the net capital spending? The equation we're going to use on those givens is net capital spending is ending net fixed assets minus beginning net fixed assets plus depreciation. I have to gross it back up by adding back depreciation. An alternative method for calculating this, if the authors would give us gross fixed assets, we would take ending gross fixed assets minus beginning gross fixed assets. No need to add back depreciation because it's already grossed up. This would give us our capital spending for the year, either method. Since we're given ending net fixed assets, we must use 3.5 million. We're going to subtract beginning net fixed assets of 2.7 million, that's 2014 beginning, and we have to gross it back up by adding back depreciation of $328,000. If I do that math, ending minus beginning plus depreciation, I get an NCS of $1,128,000. And there's your answer to problem 2.8. In problem number 9, we're given that Stilo Inc. has 2014 current assets of 4630 and 2014 current liabilities of 2190. In 2015, they had current assets of 5180 and current liabilities of 2830. Question, what is their change in net working capital? So our equation is change in net working capital is ending, which is 2015, minus beginning, which is 2014. Net working capital, and net working capital is current assets, as always, minus current liabilities from the balance sheet. So 2015 ending net working capital is 5180 minus 2830 current liabilities, and I get ending net working capital 2015 of 2,350. For 2014 beginning net working capital, I take 4630 and I subtract from that 2190 here, and I get 2440 for my beginning net working capital. Subtract those two, 2350 minus 2440, I get an answer of negative $90. And yes, Virginia, it is possible to have a negative change in net working capital. There are your answers to problem 2.9. In problem number 10, Sugar Pova's Tennis Shop has 2014 long-term debt of 1.95 million. That's your beginning long-term debt. And ending long-term debt 2015 of 2.28 million. Their interest expense in 2015 is $235,000. What's their cash flow to creditors? Now we remember cash flow to creditors is interest expense paid minus net new borrowing. And net new borrowing is ending long-term debt minus beginning long-term debt. Again, ending long-term debt is 2015, and beginning long-term debt is 2014. So, very simple problem. Interest paid is $235,000 given. And then net new borrowing is my ending long-term debt of 2.28 million here, minus my beginning long-term debt of 2014 of 1.95 million. And that gives me 0.33 million or $330,000. Subtract net new borrowing from interest expense paid, and I get a cash flow to creditors of negative $95,000. And yes, it is possible to have negative cash flow to creditors. There are your answers to problem number 10. Again, save these because we're going to use these in problem number 12. So remember this number, cash flow to creditors of negative $95,000. In problem number 11, we're sticking with Sugar Pova's Tennis Shop. They have 2014 common stock of $670,000 and 2014 paid in surplus of $4.1 million. And that's your beginning, those are your beginning values, ending up with 2015 common stock of $825K and 2015 paid in surplus of $4.4 million. 2015 dividends paid were $565,000. What is the cash flow that went out to stockholders? That's what we're solving for. So cash flow to stockholders, simply dividends paid minus net new equity raised. So we have to calculate net new equity raised. That's simply ending equity minus beginning equity. Ending equity being 2015, ending equity, and beginning equity 2014. That's your beginning period. And my total equity is my common stock plus my paid-in surplus. I just add those two numbers together. For 2015, it's $825,000 plus 4.4 million. I get a total of 5225000 total equity. For 2014, I take my 670,000, I add to that my 4.1 million, and I get 4770000 for total equity 2014. So my ending equity 2015 minus beginning equity 2014 gives me a delta of $455,000. My equity increase from 2014 to 2015 by $455,000. That's my net new equity raise year over year. So to calculate cash flow to stockholders, I take dividends paid of $565,000 minus my net new equity raised here that I just calculated and bring it down $455,000 to get a delta cash flow to stockholders of $110,000. That's your answer to problem number 11. Now remember that number for CFTS, $110,000. CFTS, we're going to use that in problem number 12. In problem 2.12, we're given the Sugar Plovis Tennis Shop has net capital spending of $1,250,000, $1,250,000, and that's 2015 net capital spending. They reduced their net working capital by negative $45,000. What was their 2015 operating cash flow? Now to solve this, we're going to use problem number 10 and problem number 11 answers as I suggested. And we're going to calculate CFFA first, and then we're going to equate that to OCF minus NCS minus CNWC. So first of all, cash flow from assets equals CFTC of negative 95,000 from number 10. CFTS from number 11 of 110,000. So I combine those two, and I get a total cash flow from assets of $15,000. Now I'm going to use that here, because I'm going to equate that $15,000 to OCF minus NCS minus CNWC. So OCF is what I'm looking for. So I have my CFFA, 15,000. I'm looking for this. I'm going to actually put in X for that. For my net capital spending, I'm going to plug in 1250000. And for my change in net working capital, I'm going to plug in negative 45,000, which was also given. Moving these to the other side and solving for operating cash flow, I get an OCF of $1,220,000. Now, if you got a slightly different answer, $90,000 off, that's because you forgot to reduce the net working capital, or reduce the change in net working capital. It's given up here, reduced it by 45,000, so we must plug that in as a negative 45,000. If you put this in as a positive 45,000 and subtracted it, you should get an answer of 90,000 different than this. This is the correct answer, $1.22 million for OCF in number 12. There are your answers to number 12. In problem 213, we have Klingon Widgets purchasing some new cloaking and machinery 3 years ago for $6 million. And that's on the books at that time. That is their book value 3 years ago. Since then, that's depreciated some. It's now showing 3.3 million, so it's depreciated to the tune of about 2.7 million, down to onto the books of 3.3 million. That machinery, same machinery, could be sold today for 4.8 million. That's market value of that machinery. Net fixed assets, as I said on the balance sheet, now show 3.3 million. That's on the books. Current liabilities on the books of $850,000, and net working capital on the books of $220,000. Current assets could be liquidated today. Again, this is now talking about market value for 1.05 million. I could sell my assets for 1.05 million, inventory, accounts receivable, and so on. What's the book value of the total assets? What's the market value of the total assets? What we want to know. So book value of assets are book value of current plus book value of net fixed. Market value of assets equal market value of current assets plus market value of net fixed assets. So there are your two equations. As we all know, if I need to calculate current assets, because it's not given, I can use a net working capital equation, because net working capital is given and current liabilities are given. So I can take my, to find the book value of my current assets, which is the first thing I need right here, I can take my net working capital plus my current liabilities, just bringing current liabilities to the other side of the equation. Current assets equal net working capital of $220,000 plus current liabilities of $850,000. Plug that in and I get current assets on the books of $1.07 million. That's the first box I have to fill. Second, I need the book value of the net fixed assets. We said we bought the equipment for $6 million, but we don't put that down there because it has now depreciated 3 years later to $3.3 million. We do put that in here. That's my book value on my books of my net fixed assets. So if I add those two together, I get my total book value of $4,370,000. Now I need market value. What could we sell those things for today if we put them out on the market on eBay or tried to sell them at auction? Current assets, $1.05 million. That is given to us up above right here. So I write that in. That's my current assets, could be liquidated today, sold for $1.05 million. And I could sell my machinery for $4.8 million, sold. $4.8 million, that's given up here. So I just add those two together to get my market value. And here I get $5,850,000 dollar bills. There's your answer to problem 213.